Okay, guys, I think we're live now. I think we're live. Let's see. I'm going to give it one more minute, allow people to get in, and then I'm going to start the presentation. Let me see. Okay. So can I get people responding in the chat? I want to know how many people are here. And I want to know who's in the chat room so I know how to tailor this webinar to. I want to know how many years you've been in business, what industry, what questions you may have, and throughout the webinar, I will address them. Okay. Give it one more. Okay, we're going to go ahead and start. So, guys, today we're talking about tax benefits and challenges for small businesses. You'll be amazed how many times the IRS has charged small businesses additional fees for not paying estimate tax payments, not paying the right amount of taxes, filing late, overpaying in taxes because they didn't talk to their CPA last minute and they didn't know that they were going to owe taxes this year. Now they're starting off a new business year with some tax debt, right? So this stuff does get a little bit frustrating when you don't know your way around taxes or what questions to even ask. So I like to make this more of a conversation rather than me just presenting on this webinar. So I'm looking at the chat always to answer questions and also basically give feedback to as well. That helps the webinar just go a little bit more smoother. So intro. My name is Christian Onyemen. Been in business for 8 years. Started off doing bookkeeping for my dad's company when I was 13. From that, of course, you go to college, learn about accounting. I didn't want to do it, but my dad kind of forced me into it. And then from college, I go work for a big accounting firm. And through the accounting firm, I realized I can go do this a different way with a better culture. So I started my own business, and now we have a team of 9 where we do anything from monthly accounting to audits to tax resolution. Okay, so that's just a brief intro about myself, but I don't want to really talk too much about myself because I want to provide some value for you today. So small businesses play a vital role in the economy. Point blank period. They supply not just housing, but they supply employment, housing sometimes. They make the economy move by generating income, and they're a staple in the community because they usually donate and support and do fundraisers for local events. One of the things that kind of destroys small businesses, your mom and pop or someone who's looking to grow, is usually they finally understand their business and they're good in operations, and they start to make some profit. They hit a big year where this is the most money they ever made, but they look at that bottom line, and that bottom line says, yeah, we're in profit, which is good, something to be happy about. But when you file your taxes, you got to pay taxes on that profit. And usually they're hit with a surprising conversation with their CPA, accountant, EA, whoever's filing their taxes, that, hey, you're going to have to owe, let's just throw a number out there, around $30,000 this year in taxes. You need to either do some type of installment plan or you need to pay these taxes in full. And they're like, oh, shoot. And guys, this happens often from other clients leaving their old CPA or bookkeeper and joining this firm. I have this conversation where it was too late to basically save them from taxation. So we say, hey, you're going to be on around $33,000. Did you brace yourself for that? Did you plan this? Is this in your budget? And always they're like, no, I didn't account for this. I didn't know I was going on taxes. The money that says that profit, I don't have that in my bank account. I'm not sure how I'm going to pay this. Most businesses fall out of place and they take a ding. It's hard to kind of get up from that. But I want to talk about ways we can kind of avoid that, right? Avoid that surprising conversation of us saying, yeah, you owe about $40,000. Do you have the money for that? I want to basically talk now while it's halfway through the year, rather than having this conversation in January of next year where we can't do anything about 2025. So this presentation will help you identify opportunities and avoid common mistakes. That's what I want, to help you avoid common mistakes. So what are the common mistakes in business? What are business owners missing out on? What are they not happy about? What are they confused about? And it's always so simple, always goes around, what business deductions am I missing out on? You'd be surprised. Even someone who been in business for about 5-7 years and they're already producing $1 million in business, they still don't have a clue what you can write off, what's going to benefit them. I like to say you can write off anything as long as it's ordinary and necessary for you to conduct business. I always tell this story. I think some of my people that follow me, they're kind of sick of it. I was able to write off golfing lessons. Not all my golfing lessons, just some. I'm still not good, by the way. But I was able to write off some golfing lessons, mainly because I used my golfing lessons, maybe about 3 or 4 of those. I used that to create basically marketing content out to golf instructors on how to do their monthly accounting. So I turned something that wasn't even CPA related, wasn't even accounting related, me golfing. Like how was I going to write off that and be able to justify that in front of the IRS? Well, I use my I purposely paid this instructor for me to get videos of me swinging. It wasn't a good swing, but I'm getting better. I'm getting better by the day. I use that instructor to help me get some video content so I can basically push that content to go market out to a potential client. I took golf, switched it over to make it ordinary and necessary for me to run my business because I'm marketing out to golf instructors in order to win their business. That's what a good business deduction is about. It's making things ordinary and necessary for you to conduct business is making you able to write that off, right? So those are the IRS guidelines. They use those verbiage too as well. Our job as a CPA is to help paint a picture of what's ordinary and necessary for your business so you can write it off. That's what our job is, right? And of course, you see on the slide here, I don't want to go too much into this. There's levels in this. We should know what office supplies, rent, and we should know those are business write-offs. So I don't want to really go into that, right? But and I want to briefly talk about some of these others, right? You see QBI, you see depreciation, you see home office, retirement contributions. You see all those. Yes, I can take about the next 30 minutes to talk about each one, but I want to get you more in the mindset frame of there's options you can do where you're not just throwing away money, spending it on a car you don't need. There's other options you can do in order to basically save on tax savings, like depreciation and equipment and assets. People tell you'll see on YouTube or TikTok, whatever you're watching, yeah, let's go buy a G-Wagon. I hate that phrase. I absolutely do. Because I have one hat that's basically saying I want to save taxes for this client, but then I have other hat on my head that says, what are the operations of the business and what do we need in order to basically help grow this business? Kind of like a CFO hat. Even if they only hire us for tax planning, I'm always thinking with those two hats. So one thing that you can do is basically ask yourself, do I need this asset in order to help grow my business? If the answer is no, we have to look at a different avenue in order to save money in taxes. It could be a retirement plan. Most businesses don't have some type of retirement plan, not in place for them or their employees or their staff. You can look into basically moving money over into the retirement plan if you don't want to buy some fancy equipment or a G-Wagon because you don't want to. It's not going to help improve your business. You can look into retirement options underneath the business. We work heavily with financial advisors to help basically set up these retirement contributions just so we don't have to give the money to the IRS. We get to store it in our account. Because I'd rather build up a great, nice nest egg rather than pay the IRS that set amount fee. So it's just a no-brainer, right? So once again, I don't want to go too much into each strategy. We can probably do different webinars about each one. I want you to get in the mindset frame that there's different options you can do in order to save money in taxes instead of just paying the IRS or setting up an installment plan. All this stuff needs to be done before you file your taxes. So we're in the year 2025 now. I want to start saving for taxes now, not in 2026 when I file the 2025 taxes. Once again, I want to start saving for taxes now rather than in 2026 when it's time to basically file and do the tax preparation. Right? So I want to briefly talk about that. Let's see if I have any questions here. Let me see if I have any questions. Anything in the chat? Nothing's in the chat. No one has any questions. I guess I'm going to keep it moving. So tax credits available. I love these. I want to talk about one in particular, but I want to talk about tax credits. So tax credits are what we call dollar for dollar deductions. It's not like a business expense. Business expenses lower profitability. Let me go back. I'll go back on this. Business expenses just lowers profitability in order for you to be taxed at a lower rate. The tax deductions are basically saying you owe $10,000 and you have a $5,000 tax credit. Now it's going to be dollar for dollar deduction on that tax liability that you owe. It's going to go down by $5,000 for dollar. That's tax credit. You will love to have tax credits rather over business deductions, because once again, business deductions is going to lower down your profitability so you can be taxed at a lower rate. And what the tax credits are going to do is going to help you save on that tax liability, that tax owed, how much you're owing to the IRS, dollar for dollar. There's different tax credits out there. My popular one, especially for restaurants, is a work opportunity tax credit, mainly because it's the IRS saying thank you for hiring distressed workers, ex-military, felons, people that can't get jobs, disabled. The IRS is giving you a credit for hiring and staffing those employees that typically wouldn't get hired anywhere else. So the IRS is giving you, hey, we want to give you tax credits for it. So you want to talk to your accountant, your CPA, EA, whoever you use. You want to talk about, hey, is there any tax credits in my industry? There's a lot in construction. So if you're in construction, you need to be talking to your tax preparer about that. There's a lot in health, right? That R&D, right here, that research and development. There's a lot in that, depending on what type of health industry that you're in and whether you do heavy research or not. But there's a lot of credits in that. Please do take advantage of it. Please do have the conversation. Your CPA should know which one should be structured underneath your tax return. And it could be very beneficial because if you're a restaurant or you own a boatload of franchises and you're hiring, people that fall underneath that work opportunity tax credit, requirement, you can get a dollar for dollar, deduction based on each one that you hire. It can help you out, especially if that franchise, and we all know about different franchises, especially if you have a lot of franchises and that profits around 1 million in profit, you're going to be owing a heavy tax bill. So that means you should start strategically placing yourself in order to get these tax credits. Common tax challenges. Common tax challenges. Once again, we can all read the PowerPoint, but I hate reading from PowerPoints, guys. I honestly like just having a regular conversation about this. Common tax challenges that most people have, there's two. We just got done with tax season about 2 months ago. There's two things that I saw that we're struggling with. It's clear communication between the tax preparer and the client. Because mind you, our job is to make sure your tax returns are filed accurately and on a timely manner. But I also need to tell your story, your financial story, onto that tax return. Right? I need to tell your story on that tax return, how much the business did, what's their assets. I need to accurately report that on your tax return. There's a hiccup right there. There's not great communication between the accountant and the client, and that needs to basically change. So we recommend basically just meeting more. Yes, it's kind of from owner's perspective, it's a little bit more chaotic, but you want to talk with your CPA more than once just to file your taxes. If they're just shooing you on, treating you like a number, it's time to probably get a new one. If they're just shooing you on, treating you like a number, it's probably time to get a new one. The second one that I'm seeing is a lot of my business owners aren't being organized with the records. So it's hard for us to do our job. They don't, and this ranges from, I mainly see this for my clients that are in that new beginning stage, making that 500K to 750, and they're just now approaching $1 million. And then that low under 5 million stage is where I see this. Their accounting records aren't always up to date. They could have their financial statements, but they probably don't have it broken down by the nexus of where they produce their revenue. So when it's time for me to file their tax returns, I don't know what states they operated in. And you could basically run risk of not filing the correct state tax return, and now you owe additional penalties and risk, right? So those are things that need to basically be cleared up. And the main thing that I feel that can resolve this is just having more conversations with your CPA outside of tax season, during the middle of the season, near the end of the year, during the halfway point of the year. You need to talk to your CPA more times. I feel like that would be a great solution in order for us to truly understand what this business is doing, what it's about, the story behind it. The impact of the entity type. I love this, guys. I've been using the same analogy for over 5 years now. And this is I use a personal story of a client. So this client, they're a waste management company. They're doing about 5 million in revenue, profits around 1.2 million, I believe, last time we checked. We just got their books to clean up. They're still filing what we call a Schedule C underneath the personal tax return. And they have over $1 million in profit. You can only imagine what that tax bill looks like. You can only imagine. The entity type that you're doing business under matters. Think of these different entity types as different grocery stores, right? You have your 1065, 1120S, 1120C, and then you have your Schedule C. I mainly want to talk about two entity types because this is what I see often. You have people that have business owners that have outgrown the Schedule C, and they have not moved over to the S-Corp yet. And the S-Corp basically is eliminating that self-employer tax, that extra 15.3% tax that you're paying if you're still under Schedule C. So let's take away all this CPA jargon and let's just kind of put it in simple terms. I'm here in Houston, Texas. We have a grocery store called Whole Foods, and then we have one called H-E-B. H-E-B is a little bit cheaper, nice, friendly spot. If you have a large family, you probably want to shop there because the cost is just lower. Eggs, milk, cheese, all that's lower. Whole Foods, a little bit on the fancier, more expensive side. So imagine going down Whole Foods and you're a Schedule C, and you look to your right, look to your left, and you see eggs and milk marked up by 15.3%. You're going to shoot, man, this is kind of pricey. I don't want to shop here. It's not cost effective. That's essentially what you're doing if you're making high profits inside that Schedule C. Now, the profits dictate between what your business are and where your business is at. But rule of thumb, people say around 60. But mind you, every business is different. So those rule of thumbs, it's just a rule of thumb. You got to really talk to your CPA and see which structure I need to be under. But rule of thumb, if you're making above 60,000 in profit, you should look into switching your entity type because you're overpaying in eggs, cheese, and milk. In this case, you're overpaying in taxes. Right? So the entity type that you're under does play a part into your business. Now, people don't talk about the S-Corp though. The S-Corp has more red tape. They're the 100 shareholders. Yes, you got to be lower than that. But where people run amok at, they don't have a proper payroll system put in place. They don't use a payroll provider. They don't know about the 941s that they have to file. And they're just a little bit confused on how much to pay themselves. I can give you a whole bunch of rule of thumbs, but mind you, I could be talking to a construction business owner on here, and I could be talking to a doctor. I'm a doctor that owns their own, clinic. I'm not having the same two conversations with that. There's two different industries, two different rule of thumbs that I need to basically mention there, just because the nature of the industry and probably the assets that fall under construction that a doctor office won't have, right? So I can't give the rule of thumb there. Just know that there's more red tape under that S-Corp. Yes, you're going to pay cheaper costs and tax because you get rid of that self-employer tax, but it does come with other red tape that you have to deal with too as well. Your job is to be aware of it. Audits triggers. So audits are ramping up lately. It's so weird. The IRS is so weird. They fire a lot of people. They shut down departments where you can't really make calls to them and resolve liens. And mind you guys, this is what I do full time. Call the IRS. They're issuing these letters. More of the story, you don't want to be caught up in an audit. It's very annoying to be caught up in a audit or a notice from the IRS saying that you have underreported income that you need to basically prove, and we assess your taxes for you, and that assessed tax that they assess for you is basically $50,000 more than what you thought you were going to be paying in taxes, right? You just want to avoid all that. One best way to kind of avoid all this, have accurate data at hand. There's a client that I helped that we basically solved his case mainly because he had all the documentation. It was easily provable. He had all the documentation, right? He had everything to prove for. But if you see on the screen here, excessive deductions, round numbers that you're basically reporting, inconsistent income reporting, all these could trigger an audit because those are things that they're looking for. What they're doing in some cases, they're matching up, let's say on your personal tax return, they're matching up your wage and income transcript report to see what's missing on that and that wasn't accounted for on the tax return. And if there's any discrepancies, I don't think a human's even looking at this. It's all machine based. So if they notice that some things are missing, they're basically flagging that, and then they're going to start sending you these letters. And it's all automated. So it's never a human behind this situation until it usually gets to a revenue officer. But everything's systemized in a way, or highly systemized. So one way is to kind of avoid that. If you really want to check that wage and income transcript to make sure everything's reported on. What that wage and income transcript is, it shows all the wages and all the W-2s, all the 1099s that you have underneath that social. It shows everything that's been accounted for already. Everything. And this kind of goes back to what I was talking about earlier. And all roots is just more conversations. We say year-round tax planning tips. Those are just a series of conversation. I had a realtor making great money, didn't have no accounting system. I said, hey, we got to put you an accounting system. We have to be able to know what our profit is at the end of the year instead of just making up numbers when it's time to file your taxes. And then I see a high tax bill, right? So having an accounting system put in place, talking to your tax professional, I want to say at least 3 or 4 times a year. One at the beginning, say, Christian, what do I need? One for when I file your taxes. One to talk about the result after tax season, talk about the results and what you need to do for 2025. And at least one towards the end of the year where we're doing like a maintenance check or like a recap, really. So around 4 or 5, to be honest, is how many times we should be talking. And then keeping personal and business separate. A lot of my business owners that's making that, low millions, high around 5 million range, they're fine with that. It's my startup that just got into business. Of course, it makes sense. They're using their personal funds to help fuel the business. But you do want to avoid doing that. It's sloppy business. It causes you to lose that, that segregation. So you want to keep things separate just so you can easily prove some of your expenses to the IRS. So you do want to just keep things separate and organized. You don't want to commingle any funds. And we kind of just already talked about that. When to call a tax pro, beginning of the year, when they're done with your tax return, after you got the results from your tax return, whether you owe or not, and towards the end of the year. Towards the end of the year. You want to, more of the story, you want to talk to them more than once. Got to talk to them more than once. I know in my firm, we're currently going through 15-minute check-in calls. Just call and just say, hey, checking in. What's going on? How's the business? Anything you may need? We need to do this. And that's me doing a check-in because I know they need to talk to me more. So yeah, my major thing that I want to accomplish during this webinar is to let you know that you need to talk to your CPA more. You need to leverage your deductions and credits, and you need to be aware of your business. You don't need to be surprised that you had a $40,000 or $150,000 tax bill out of nowhere. You want to have a game plan for it already. And thank you. Recently moved office, so that needs to be updated. But I just want to say thank you guys. Hope you got some good tips from this, and let me know if you have any questions. Our contact information is up there if you want to contact us. If you want to call us, our number's right there. I'm going to leave this open for just a little bit. But other than that, y'all guys have a great night, and let us know if you need anything. Thank you.